What if I told you the modern stock market wasn't created to make ordinary people rich, but to protect powerful merchants from collapse? It didn't begin in New York or London. It began in a European port city most people rarely study, Antwerp. And it wasn't designed for fairness. It was built as a survival tool when global trade became too big, too risky, and too unstable to manage. The moment wealth became paper instead of cargo, everything changed. Risk didn't disappear, it moved. Prices detached from reality. Liquidity became power, and the system that was meant to stabilize trade ended up reshaping empires, fueling speculation, and creating bubbles that still define our world today. The modern stock market was not born in New York, it did not begin in London, and it was never originally designed to help ordinary people slowly build wealth over decades. Its origins trace back to a European port city that many outside Europe have barely studied, Antwerp. And it was created for one central purpose: to prevent global trade from collapsing under its own growing complexity. To understand why Antwerp matters, we have to look at the world before it. During most of the medieval period, trade was personal, local, and limited in scale. A merchant financed his own voyage, relied on a tight circle of trusted partners, and carried the full weight of risk himself. If a ship sank in a storm, the loss was absolute. If pirates attacked, the merchant absorbed the damage. If war erupted between kingdoms, bankruptcy could follow overnight. Risk was concentrated, slow-moving, and brutally unforgiving. This system functioned reasonably well when trade routes were short and predictable. But everything changed in the late 15th and early 16th centuries when European trade expanded across oceans. Voyages now took months or even years. Ships traveled to Asia, Africa, and the Americas. Cargo values soared. Prices fluctuated wildly while ships were still at sea. Political shocks in one region could ripple across continents. Suddenly, no single merchant, and not even most governments, could comfortably absorb that level of uncertainty. Global trade had outgrown medieval finance. This is where Antwerp enters the story, not as a conquering empire but as something more subtle and more powerful: a financial junction. Antwerp sat at the crossroads of major trade routes linking the Mediterranean, the Atlantic world, and Northern Europe. It did not dominate through armies or territorial expansion. It dominated through liquidity. Merchants from across Europe converged there because it became one of the few places where goods, credit, insurance, currency exchange, and information could all be accessed in a single marketplace. For a modern comparison, it wasn't simply a capital city. It functioned more like a global financial hub that quietly priced the world without politically ruling it. As trade intensified, a quiet but revolutionary shift began to occur. Merchants stopped focusing only on owning ships and cargo. They began focusing on claims on shipments, claims on profits, claims on voyages that had not yet returned. Paper promises started to matter more than physical goods. This conceptual leap changed everything. Instead of tying wealth to one risky voyage, merchants could divide that risk among multiple participants. Instead of waiting years for a ship's return, they could sell their claim early. Instead of being trapped in uncertainty, they could convert uncertainty into something tradable. Antwerp did not invent the idea of shares. Variations had existed before. What Antwerp introduced was continuous secondary trading, a permanent, organized space where these claims could be bought and sold at publicly visible prices on an ongoing basis. This was the birth of the modern market structure. For the first time, wealth became abstract and portable. You did not need to know the captain. You did not need to inspect the cargo. You did not even need confidence in the voyage itself. You only needed confidence that someone else would buy the claim from you later. Once claims became continuously tradable, prices began moving independently of physical reality. News began to matter. Rumors began to matter. Timing began to matter. Those closest to information gained a structural advantage. Risk did not disappear, it migrated. It shifted from physical ships at sea to fluctuating prices in the marketplace. It is important to clear up a common myth here. The first stock exchange was not a democratic innovation. It was not designed so ordinary people could gradually invest their savings. It was a survival mechanism for powerful merchants and states operating at scales that were becoming unmanageable. It allowed elites to unload portions of risk, gain liquidity quickly, and fund expansion without bearing the full consequences themselves. Markets did not make trade safe. They made it survivable for those with access to them. Antwerp's exchange quickly became a sophisticated machine for pricing uncertainty. Wars, embargoes, shipwrecks, and political instability were no longer just disasters. They became variables, and variables can be traded. Capital flowed toward this innovation. Speculation followed. Prices increasingly reflected expectations rather than outcomes. Merchants who never physically touched goods could profit simply by trading paper. Speed, proximity to information, and scale became decisive advantages. But financial innovation almost always moves faster than political stability. Antwerp thrived in a world growing more volatile, not less. Religious conflicts, imperial rivalries, and shifting alliances made trade unpredictable. Unpredictability fed trading activity, but it also made the system fragile. When wars disrupted routes and political authority shifted, Antwerp's dominance weakened. Liquidity, which depends more on confidence than geography, began to migrate. The exchange did not collapse because its model was flawed. It declined because finance cannot float indefinitely above politics. This is one of the first hard lessons of modern markets. They do not stay loyal to places. They stay loyal to stability. As Europe fractured under religious wars and imperial competition in the late 16th century, capital moved north to Amsterdam. The Dutch Republic did not merely copy Antwerp's model. It perfected it. Legal protections became clearer. Property rights were stronger. The state aligned itself with commercial interests rather than overpowering them. Finance gained a degree of autonomy that earlier empires had not tolerated. This is where markets stopped being tools used by merchants and began evolving into engines of state power. Amsterdam's exchange became the backbone of empire. The Dutch East India Company raised enormous sums of capital not because voyages were guaranteed to succeed, but because its shares were liquid. Investors did not need certainty, they needed buyers. That subtle psychological shift reshaped human behavior. Risk became something that could be exited before being realized. Gains could be locked in early. The market rewarded anticipation rather than patience. Speculation was no longer a side effect, it became strategy. This is where the first major financial bubbles emerged. Not because people suddenly became irrational, but because the system made optimism itself tradable. Prices reflected expectations of expectations. Paper wealth expanded faster than underlying trade. When reality intervened, corrections were severe and uneven. This was not a malfunction, it was embedded in the architecture. Systems designed to absorb uncertainty do not eliminate it. They amplify it, redistribute it, and often delay its consequences. By the time London rose in the 17th and 18th centuries, this financial logic had matured. Markets were no longer regional solutions. They became global infrastructure intertwined with empire, war finance, and industrial expansion. Governments borrowed through markets. Corporations scaled across continents. Risk was sliced, packaged, and sold widely. The distance between cause and consequence grew larger. Modern markets still operate on the same structural DNA first visible in Antwerp. Abstraction, liquidity, continuous pricing, and exit over accountability. They are extraordinarily efficient at mobilizing capital quickly. They are far less effective at ensuring that those who benefit during expansion are the same ones who bear the costs when contraction comes. Every major financial crisis since has followed a similar architectural pattern. New instruments promise flexibility. Liquidity expands. Risk moves away from visible hands. Prices detach from fundamentals. And when the system snaps back, the damage falls unevenly. This is not a moral accusation. It is a structural observation. The stock exchange was never built to create fairness. It was built to keep complex economic systems functioning under stress, and it performs that function remarkably well for the system overall. Individuals, however, experience it very differently depending on their position within it. Antwerp's true legacy is not a building or a city, it is a mindset. The belief that uncertainty can be priced, traded, and managed even if it cannot be eliminated. That belief powers modern finance, but it can also blind us to limits. Some risks cannot be abstracted away. They accumulate quietly outside balance sheets until markets are forced to recognize them. And when that recognition happens, liquidity can vanish faster than it appeared. Understanding where markets came from changes how we interpret their behavior. If you believe stock exchanges were invented to help ordinary people build wealth, you will always be surprised when they behave harshly under pressure. If you understand they were created to help powerful actors survive volatility, their behavior becomes far more predictable. The lesson Antwerp leaves is not cynical, it is clarifying. Markets are powerful tools, but they are not neutral and they are not moral. They reflect the priorities of the systems that built them. They reward speed over patience, exit over responsibility, and abstraction over deep understanding. Once you recognize that, you stop expecting markets to act as guardians and start treating them for what they have always been, mechanisms designed to manage risk in an unstable world. History may not repeat, but financial architecture endures. If this gave you a new perspective, hit subscribe.